Hello and welcome to Dollars and Cents, the Australia Institute podcast where we're talking about just what the hell is going on in the economy. I'm Elinor Johnston-Leake, the senior content producer here at the Australia Institute, and as always, I'm talking to our chief economist, Greg Jericho. Hello, Greg.
Hi, Elinor.
And before we get into the show, I'd just like to thank everyone for all the emails you've been sending through. We've been getting quite a lot. We'd like to do a Q&A special sometime in the next few weeks. So if you have any questions for Greg, please send them through to podcasts@australiainstitute.org.au. So Greg, in the news this week, the Greens party leader Adam Bandt appeared at the National Press Club to announce what's been called a Robin Hood tax on excessive profits.
The Greens are going large, vowing to increase taxes on big business to the tune of $500 billion.
People who are struggling to keep their head above water are going under, pushed down by billionaires and big corporations that make massive profits, which are driving up inflation in the economy and the prices of things that everyone needs. We've designed this to ensure that there's still continued investment. We're just saying when you make these big whacking great profits, do what other countries do and say you've got to give a bit of it back to the public because that's who you're making the money off.
Your opponents are saying this is where it's heading in a minority government. Can you rule that out?
Yeah, the Greens, their primary task is to, make up numbers and put out press releases. We actually have to run the place, run the economy and run the country.
Politicians like Adam Bandt may like to see themselves as Robin Hood, but this movie has been played out again and again throughout history, from the former Soviet Union to Venezuela. They go from being Robin Hood to being the sheriff of Nottingham, and it ends in a disaster.
Yeah, it's kind of weird. I mean, Robin Hood taxes, when I first saw the reports they're going to do a Robin Hood tax, I thought they were going to do a wealth tax because that's often what we associate with Robin Hood taxes, where you're
stealing from the rich, giving to the poor.
Yeah, and generally it's rich individuals, and so it's looking at wealth taxes, and it wasn't that.
So if it's not a tax on individual wealth, what is it a tax on?
Essentially what it is it's a tax on super profits of big businesses, and in some ways there's a three-pronged attack. One of the prongs, which is a tax on essentially mining, specifically a tax on coal and iron ore, they're the main focus. And what we're seeing there is kind of a return to the old mining super profits tax of that Wayne Swan tried to bring in, and essentially just bring that back. And so we're talking 40% tax. There's a whole lot of rigmarole around royalties and things like that, but essentially a 40% tax on excess profits. What they're also doing, though, is they're not just going to have a mining super profits tax. They're also going to have a all super profits tax on all businesses, whether you're a bank, whether you're a supermarket, whatever. And that, again, is a 40% tax on excess profits. What they define as excess profits is they give you a 5% return plus a standard bond rate return. So in a sense, a 5% return plus kind of what the standard interest rate is on business loans and things. Okay. So they're basically saying you can make 5% plus, let's say you're paying an average of 4% on your loans across businesses, then it would be any profits above that 9% return are going to get taxed at 40%.
Yeah. And are a lot of companies making these kinds of profits at the moment?
Yeah, well, I mean, the Greens suggest that, they've gone to the Parliamentary Budget Office and got this costed, and they are saying, it would raise over the next 10 years a bit over $500 billion.
Oh, yeah. Significant chunk of change there.
Yeah, we're talking, $541 billion. That's a fair bit. They're, for example, suggesting that they've got some estimates of, for example, what the Commonwealth Bank, they're saying would have paid an extra $1,500 million or $1.5 billion extra in tax. So they paid $4.1 billion. They would have paid another $1.5. Westpac, they paid $3 billion in tax. They're suggesting they would have had to pay under this $380 million more. And really it is the banks, because the bank's doing really well.
Listeners of the podcast might remember, was it last episode?
I think it was last week. We bashed the banks. Yeah, the banks.
Because they were saying we aren't quite making enough huge profits.
Yeah, so this would really get those. Others, things like Wesfarmers, Telstra, Coles, Woolies, they would certainly be under the gun on this, but really it's the banks who would be hit. So they're the first two, and then the last one is something aimed purely at gas and oil, and that's a real reform of the Petroleum Resources Rent Tax that we have talked about in the past, about how the PRRT is just completely broken.
Yeah.
Gas companies, because they can carry forward losses, and those losses are subject to rates of return that means they can increase, means they can pretty much avoid ever
Just
saying we've got any
indefinitely.
excessive profits, so we don't have to pay it, regardless of how huge your actual profits are. So they're essentially saying they would get rid of a few of those loopholes, get rid of the ability to carry forward those losses at such a massive amount. So it's those three things, basically mining, banks, and oil and gas.
Yeah.
Are the three things. And it's all about those excess profits. It's not about, we've certainly been strong in our advocacy of keeping the company tax rate at 30%. Back when the former government was attempting to lower the company tax rate to 25%, we really fought strongly against that at the Australian Institute here and produced a lot of really good research showing that this would do nothing except deliver a mozza to big companies. They wouldn't increase investment and things like that. And so the government actually, to their credit, didn't, and only introduced lowered the company tax for small businesses. So it's not like the Greens here are saying, oh, let's raise company tax.
Yeah.
Overall, it's like, no, what you're paying on your normal profits that you need to make a good return that makes you a viable business to invest in. You're going to be able to grow and invest more and employ more and all that. That's just going to still get taxed at the same rate. But it's when you're making those excessive profits that we know from history are really not things that anyone is planning for. No one is saying, oh, I need this company to make a 15% return or things like that. And generally they happen because of either freak events like
the war
pandemics, war in Ukraine,
Yeah.
things like that. None of that happened due to your good work.
No.
So let's
just,
actually
you got
tax
lucky.
them. And if we do tax them at a higher rate, no one's going to say, oh, you're not a good business to invest because you're making excessive profits. So they're still pretty happy.
Yeah.
And it's just a case of let's get an actual real return on these things rather than it essentially, as we've seen very much with gas companies and banks doing very well and the Australian public not really getting what we would argue is a fair return. So we certainly, I can say we applaud this. Obviously, it's always contentious when you go after companies.
Yeah. Have any of those companies said anything about this yet?
Not that I've read so far. They've all sort of, there's the usual sort of, this will hurt the economy and everything.
Yeah,
and
this is terrible for investors.
Yeah, it's mostly been painted as a bit of a political difficulty for the government because you're going to have the Greens pushing for this after the next election. And so you do have conservative media outlets saying, oh, if it's a minority government, this is what the Greens are going to be demanding.
Yeah.
And, there might be some of that, but it's also a case of, and this is something I've sort of been thinking about, been looking at, is if you do have an excess profits tax that's actually a real legitimate one, that does give you scope for maybe looking at other areas where you can reduce taxation overall. And it's similar to what we saw during the 1980s, that all the old fart economists and political reporters all laughingly refer to on the Hawke-Keating bipartisanship era, which wasn't bipartisanship at all. The Liberal Party hated all the tax moves that the government did, but things they did was they introduced the capital gains tax, introduced fringe benefits tax, but in doing so, they reduced company tax at the same time. So they sort of broadened some things, brought down other things, and that's certainly something that the government might be able to look at, and they go, okay, yeah, we'll tax super profits, but maybe we'll reduce overall company tax to 28% or something like that. That might be the political
strategy
that they could do, but it would require the government actually showing some sense of leadership.
We'll see.
We'll see. But yeah.
Major Australian companies have been reporting massive profits and they're having a big impact on inflation.
It is companies that decide how much they're going to charge for the goods and services they produce. And it turns out they've been doing much more than just passing on their own higher costs.
What we're seeing actually is a greed price spiral. That's what's happening. This inflation has been driven not just by overseas supply issues, it's been driven by excess profits.
So we mentioned the banks already, but what other kinds of companies are making these excess profits?
Yeah, I mean, what's happening right at the moment is we've got report season, as they call it in business, because all companies that are listed on the stock exchange are having to release their reports, their annual reports, how they're doing. And we've seen some pretty good results. Good if you're a company.
Yeah, good if you're a shareholder.
A classic one was Medibank Private last week. Showed that they had a profit increase of, hold your breath, especially if you're a Medibank Private holder, 62.5% increase in their profits. 62.5%
increase.
Yeah, and one of the things about these reports, they have to give out what their costs are and things like this. Medibank Private in that year that they made a 62.5% increase in their profit only increased the amount that they were paying their employees and their suppliers by a touch over 4%. And in that same period, we can look at the inflation figures and we know that the cost of all insurance went up 15%. So
where did this 62% increase come from?
It came from them not having to pay their workers and their suppliers much, being able to increase their prices, and they took all the cream, shall we say. So for us, it was just a really good indication of the fact that whenever you hear scares about, wages driving inflation, no, profits are driving inflation. Companies are the ones who charge prices. We saw Woolies and Coles as well. They came out with their profits, some really good profit growth, especially for Coles. Woolies, not so much, but still 6% increase in their supermarket food area over the last year. They were able to increase their profit margins from 6% to 6.1%.
Yep.
Coles went from 4.8% to 5%. And for context, back before the pandemic hit, when we all had to start going shopping and buying toilet paper because there was no alternative, and so not surprisingly, the grocery chains did really well during this period. Before that, Coles' profit margin was around 3.8%. Then it jumped to 5%, and it stayed there.
Yeah.
So it's not a case of, and we see this a lot, and we even saw this in this week. There's been a few commentators saying, oh, no, companies and profits haven't caused inflation. This is just they're protecting their profit margins. And we're saying, no, what they did was they protected their excess profit margins. Yeah. The fact that they were able to keep their one-off high profit margins when every other shop was closed except for theirs is not a sign of either a good competition or of companies, in a sense, not acting greedy. We really think that the fact that Coles and Woolies were able to keep such high profit margins is an indicator that actually they were contributing to inflation, because in normal cases they wouldn't have been able to raise their prices like that to protect their margins. They would have had to keep prices a bit lower,
keep being competitive,
and that would have reduced inflation. And another one, and this one is really quite crucial to the Greens thing about improving the PRRT, the Petroleum Resources Rent Tax. Woodside, and this is kind of jaw dropping. The amount of sales, or selling Woodside, selling their gas, fell 19%. The amount of money they got from selling gas fell 19%, but their profit after tax rose 11.7%.
So how?
The reason why they paid, and the note is profit after tax, they paid a hell of a lot less tax. The amount of PRT they paid fell 75%. It went from being about 600 million to about 100 million. They paid a lot less tax.
If that's not a sign that something, the PRT is completely broken.
Completely broken.
I don't know what is.
When normal businesses, when the amount of money that you're taking in from what you're selling falls by 19%, once you've done your tax returns and everything, you shouldn't be getting an improvement in your tax. You should be kind of worse off and struggling. No, their profits after tax went up nearly 12%. I mean, this is just One, it's a sign. So we look at what's happening with Woolies, what's happening with Medibank Private. Profits drive inflation. When we look at what's happening with Woodside, it's a real case that our tax system is stuffed. And so you put all those together, and I think what we're seeing from the Greens and certainly what we've been advocating with the super profits or a windfall profits tax, I think it demonstrates it's very much needed.
The figures have just dropped. So at an annual rate, inflation is now 3.5%, down from 3.8% in the month of June. But basically, that electricity rebate is really the key reason why inflation has fallen this month.
First of all, there's nothing artificial about trying to help people with their electricity bills. And our opponents don't support that. That's fine. But we're providing this energy bill relief proudly and for good reason. That's because people are under pressure.
So, Greg, on to something a bit different. The Australian economy has not been doing too hot recently. Not as bad as it could be, but not great. But new inflation figures are out this week. Are we doing any better?
Well, inflation, the latest inflation figures that came out this week were the monthly ones, so not the all-encompassing quarterly figures, but monthly ones, which give us a good guide, and they actually saw inflation fall. It's now down to 3.5%, which is better, and especially when you think about the Reserve Bank has 3% as its sort of ceiling. That means we're kind of within shouting distance of that. So that's very good. A significant part of the reason, though, why we saw a drop in inflation was because of the government's energy rebate on electricity, which actually meant in that month that the energy rebate came in, electricity prices fell 15%.
Yeah.
Now, the prices didn't fall 15%. The amount that we were paying fell 15%, which is, to be honest, really all that matters. I don't really care what the price is if I'm paying 15% less because of government rebate. I think that, and that sort of goes to what we've been always arguing, that governments can reduce inflation
with targeted spending.
Targeted sort of, in a sense, it kind of acts as a price cap. These subsidies. We've seen this in the past with things like childcare. They're good to bring in when inflation is higher, when inflation and costs are rising due to things that got nothing to do with people. It's not like we're out there spending a lot more on electricity than in the past and it's just market forces. No, there's supply side issues. There's, as we've seen with things like Woodside and the price of gas and all that flows through. So it's smart that the government is helping there. And it reduces overall inflation. So in a sense, it reduces the pressure for workers to be after higher wage rises, which we certainly know wage rises have not been even keeping up with inflation. But when you've got overall inflation, your costs are rising, it basically takes a bit of pressure off of that, and that helps reduce inflation overall. So the inflation picture, much better. I mean, there'll be those whinging about, the underlying thing and all that. But to be honest, I when I compare it with what's happening in America and Canada, we're pretty much on pace with them when you compare the months before and after the peak. Their inflation peaked a few months before us, so they're a bit lower than us right now. But when you look at it in terms of months since the peak, we're basically on track with them. So I don't think there's any
things
panic.
Are looking up.
Yeah, I don't think there's, and certainly there's nothing in these figures that would suggest there's going to be another rate rise. Probably won't be a rate cut, and it sort of goes to what I've been saying that, I think if the first rate rise, if we're going to get one, my sort of guess would be end of the year rather than the next meeting. I think sort of more November, December than now.
And we've talked a fair bit about unemployment recently on the podcast. You write in your column in The Guardian this week that the rise in unemployment in Australia looks like it could potentially trigger the SARM rule, which we've mentioned before, but you're optimistic that we won't go into a recession. So first off, can you just remind everyone listening what the SARM rule is and why you're so uncannily optimistic?
Yeah, I'm so chipper.
Yeah. So you like you.
I mean, we've talked about the SARM, and you're right. We've talked about the SARM rule a lot, and it's quite interesting. Other commentators now are starting to talk about it as well. Clearly, they must be listeners.
You talked about it before it was cool, though.
Yeah. Literally, I was talking about it in 2020 when it was a real academic sort of thing, and I was banging the drum
Such
on my
a
own.
nerd.
Everyone's going, "What are you doing?" Claudius, American economist, came up, sort of looked at how we measured recessions as 2 consecutive quarters of GDP going backwards, and thought, well, that's a terrible way to measure it. It's by the time we find out we're in a recession, it's too late to do anything because we're in a recession.
Yeah.
And she was like, okay, well, what really happens in a recession? Unemployment rises.
Yeah.
And unemployment is, in a sense, a leading indicator. It lets us know. Businesses are pretty good. They know when things are not that great because they're right at the coalface. And they will either stop hiring or reduce hours, or they will cut back on staff.
Sort of a canary in the coal mine.
Yeah, they do it quicker than overall GDP will show up, especially if you got things like government spending, you got exports, all these things that can kind of muddy the waters. And so she was like, okay, well, let's just look at unemployment. And there's a bit of averaging going on to get rid of some of the noise, but basically she was saying if unemployment rises by 0.5 percentage point in 12 months, in the past, when that has happened, we've gone on and had a recession.
Every time?
Yeah, in America, pretty much. And in Australia, there's been a couple periods where we've got on around 0.5 and a bit, and we haven't kept going up, most notably in 2013 and 14. And this has caused the Reserve Bank to say, oh, we're here in Australia, it's not a 0.5 percentage point, we need 0.75 percentage point. I'm kind of like, I don't know about that. I'll stick with Claudia's.
Better to be cautious.
Well, and as I wrote in the past, what are the helpful reasons why the Reserve Bank suggested 0.75% was that they were actually, in their figures, were predicting unemployment would rise by 0.5 percentage point. So if they were keeping to the SARB rule, they would actually have to be saying, yeah, we're predicting we're going to go into recession territory, which probably is not a
Let's just move the goalposts a little bit. Yeah.
So the upshot is, though, in the most recent labour force figures, we haven't hit the 0.5 percentage point marker yet. We're at 0.49.
That's very, very close.
Yeah, so if we did a bit of rounding, we're there. And what happened also last week, Deloitte put out its sort of report on how's the economy going, especially with labour force. And in their figures, they were predicting a rise in unemployment. And ABC interviewed a couple economists about this. And one of them said, well, actually, if you look at this, if this happens, we're going to go over the SARM rule of 0.5 percentage point. We'll be in a recession sort of period. And so that kind of can freak everyone out. It's like, oh, shit, we're going to go in a recession. And it's like, well, maybe. The thing to remember is the reason why she came up with this was not to sort of give a different predictor of or measure of recessions. It was to say when unemployment rises by 0.5 percentage point in a year, that is the point at which governments and central banks, so our Reserve Bank, should go, right, we got to start doing something now.
Yep.
We can't wait 6 months to find out, are we going to go in a recession? It's like, in the past, this has been a bad sign. Do something now to stop us going to recession.
Yeah.
And the next figures that come out, unless the unemployment rate falls, we'll definitely have gone over a 0.5 percentage point increase. Doesn't mean we're in a recession, but it should mean that the government should be, and the Reserve Bank should be, certainly not raising interest rates. But the other thing is, I sort of thought, okay, well, that's the overall figure. The good thing about the labour force figures and all the data from the ABS has is you can actually break down labour force by age. And this is where I think we found a really interesting thing that kind of gives me a bit of optimism.
What's the thing that's giving you a bit of optimism?
The optimism is it's that the young people are being screwed.
I think you and I might have different definitions of optimism here, Greg.
Look, it's not great.
Certainly, doesn't sound great.
What we're seeing when you dig into the unemployment figures, the main reason why unemployment has risen nearly 0.5 percentage point is mostly because of an increase in unemployment for 15 to 19-year-olds and a little bit more for 20 to 24-year-olds. Now, look, that's not a good thing. And certainly in the past, youth unemployment can be, again, another canary in the coal mine, because if you're a business and business turnover is weak, who do you get rid of first? You get rid of the young people first.
Yep.
They're less experienced. They have less skills. They're generally working part-time anyway, so it's easy to cut back on them. You're not losing someone who's got a lot of corporate knowledge or things like that. So they're generally always the first to go. So whenever you do see unemployment rising or we go into recession is normally the young people go first. If you look at what we call the prime working age of people between 25 and 64, unemployment's been doing okay. It hasn't risen. It's certainly not at a point where you go, oh, this is what we normally see in a recession.
Yeah.
It's just what we'd see in kind of weak periods like we saw around 2013, 2014, where, again, youth unemployment rose pretty strongly, but that, as we call it, the prime working age, we call it prime working age because that's the period where you are more likely to actually be full-time and you're actually earning good money.
Yeah.
You know, when you're 15 to 19, you're often studying and working, same 20, 24.
Staying
often,
with your parents.
Yeah. You're generally not going to be the main earner in your household.
Yep.
So, yeah, certainly it's not great if you can't get work, but it's generally not a calamity like it is if you're a 35, 40-year-old and you're unemployed. That's
with
often
kids
the
or
case.
Something.
Yeah, that's often a case of this is really bad. And also that's often a case of when unemployment of people in those ages are rising strongly, that really is recession town. And we're not seeing it as badly as we have in past recessions right now. We're just seeing it at points where things are weak, which means, okay, probably not a recession, but we could go into one if the Reserve Bank, for example, was stupid and decided to raise interest rates because they're worried about 3.5% inflation. Or if the government was like, oh, everyone's attacking us for our spending, we better be very austere and we'll cut back, which is kind of what Joe Hockey sort of did during 2013-14. And we didn't go into recession, but the economy just really almost sort of stalled a bit. Unemployment stayed high. Things were very weak. And then when Hockey left, the Liberal Party abandoned the whole austerity thing. The Reserve Bank also started cutting interest rates, and lo and behold, everything sort of got a bit better. So
who would have thought?
What we see from these figures it's a case of things are okay. They're not recession, but they're not great. I mean, the unemployment rate is 4.2%, so historically low. So you think, oh, that's good. Employment growth is pretty strong. You think, that's good. Unemployment is rising a bit, though. That's not good. Youth unemployment rising pretty strongly. That's a bad sign. It's all a bit murky. Where another thing that is kind of a bit of a concern for me is when you look at hours worked.
Okay, so like people working part-time.
Yeah, it's a bit of that. It's hours worked is a really good stat, I think, of how healthy sort of the labour force of the economy is, because people might still have a job. It's just they've gone from working 38 hours a week to 30 hours a week. Or they've gone from the part-time doing 25 hours a week and they've been cut down to 16. The great thing about the hours worked then is we can see whether, okay, people have still got their job, but they're not working as much.
Yeah.
And what we can also do, and this is a measure that I think is probably the best measure of the health of the labour force, is you can basically do the average of hours worked per head of population, regardless of whether they're working, whether they're staying at home, whether they're educated or not. It's a really good sign of, okay, how many people are actually working in our economy and what type of hours that they're doing.
Yeah.
And why it's important is because we always see during a recession that figure drop.
And are we seeing that figure drop now?
For men, we are. And the problem for men is pretty much since, say, the 1982 recession, we've seen it fall and not really recover. Then it fell again during the 1990s recession, didn't really recover. Sort of recovered a bit during the mining boom. Then we had the GFC. It fell again, didn't really recover. Had the pandemic. Then we had this really absurd sort of recovery. It did recover, but now it's fallen again and it's back to where it was before the pandemic.
So why is it just men falling and not women?
Because the amount of men who have got a job has always been high. There's not, and this is when we talk about gender pay gaps and gender employment, there's generally not a lot of focus on trying to get more men into work because there's already a lot of men working.
Yeah.
Where it's tricky for looking at women's hours or average hours is because it's actually been growing over the past 40 years. But that's not because their employment is a lot healthier. It's just a case of more women are coming into the workforce.
Yeah.
And it's a case of also we've seen an increase in the services sector. You know, you think over the past 40 years, what have we seen? A big shift from manufacturing to healthcare to education, services. And in the past 5 years, what have we really seen? A lot of a big boom in the care sector and a big boom in things associated with NDIS.
And those are dominated by women.
And so the hours worked by women on average has risen really strongly over the past 5 years, but it hasn't fallen, but it's pretty much plateaued over the past year. So putting those together gives me a sense of, okay, not recession again, but not strong. It's as hard now for men in that 25 to 64 age bracket to get hours as it was before the pandemic in 2019. And people kind of forget this, but in 2019, I was writing a lot of columns about, are we going to go into a recession? I even interviewed, when I was working for The Guardian then, interviewed economists where there was an entire sort of column about these are things that economists are suggesting the government should do to avoid recession. The economy was really bad.
Yeah.
And in some ways, the pandemic kind of saved Scott Morrison at the time because things were really shocking. You'd just gone through the fires. Things were bad. Everything was going to hell, and then the pandemic came.
And then it went even more to hell.
So getting back to 2019 levels is not a good thing. It means the economy is now really weak. Next week, though, we get the latest GDP figures. That will give us
so
overall picture.
Stay tuned.
Yeah.
Well, thank you, Greg.
Thank you, Elinor, and thank you, everyone, for listening. Yep, next week, GDP figures. That's for the March quarter of this year. This episode of Dollars and Cents was recorded on Thursday, the 29th of August, and some things may have changed. You can find my column Grogonomics, which has all the graphs looking at whether or not we are going to recession, on the Guardian Australia site. And for more research, especially a lot of stuff on how we need to reform our tax system and actually tax excess profits fairly, on our website, which is at australiainstitute.org.au. My Twitter handle and the handle I use for all social media is @GrogsGamut, and Elinor is @Elinor_.
@ElinorJ_L.
Okay, I completely got that wrong. Our theme music is from Blue Dot Sessions. Thank you all. Have a great week and see you next week.
See ya.